Cha. Warning: IRS is flagging. These 5 AI automation deductions in 2025, 3 weeks ago, my accountant called me panicking. The IRS had flagged $4,200 in ChatGPT expenses on a client's return. Turns out, there's a right way and a catastrophically wrong way to write off AI tools. Here's what nobody is telling you. The IRS hired 4,000 new agents in 2024. And they weren't trained on crypto. They weren't trained on real estate loopholes. They were specifically trained to identify AI-related business deductions. You know why? Because last year, Americans claimed $2.3 billion in AI software write-offs. The IRS believes at least $800 million of that was fraudulent. And the scariest part? Most of the people who filed those deductions had no idea they were doing anything wrong. I'm going to walk you through the 5 specific AI deductions the IRS is flagging right now in 2025. But here's what you really need to understand. And this is something I'll explain in detail around Minute 8. One of these deductions is actually completely legal, and the IRS is flagging it anyway because they don't understand how the technology works. If you know how to document it properly, you can still claim it. Most people don't. I've spent the last 3 months interviewing tax attorneys, CPAs who specialize in digital businesses, and one former IRS auditor who now consults for content creators. What I learned completely changed how I handle my own taxes. By the end of this, you'll know exactly which deductions to avoid, which ones are safe, and the specific documentation that protects you if you ever get that terrifying letter in the mail. Let's start with the deduction that's burning people the hardest right now. The first deduction getting flagged is the blanket ChatGPT Plus subscription write-off. And I need you to understand something. This deduction isn't inherently illegal. The problem is how people are claiming it. Here's what's happening. A 24-year-old named Marcus, real person, name changed for privacy, runs a small Etsy shop selling digital planners. He uses ChatGPT to write product descriptions, brainstorm designs, and respond to customer emails. In 2024, he spent $240 on ChatGPT Plus. He wrote off the entire amount as a business expense. Sounds reasonable, right? It's a tool he uses for business. The IRS disagreed. They audited Marcus in February 2025. The agent asked one question that destroyed his case. Do you use ChatGPT for anything personal? Marcus hesitated. Because of course he does. He uses it to plan meals. He uses it to help write texts to his ex. He used it to draft his fantasy football team strategy. The agent noted that Marcus couldn't prove what percentage of his usage was business versus personal. The IRS disallowed the entire deduction and charged him $47 in back taxes, plus a $94 penalty. Now, $140 isn't life-changing money. But here's what kept Marcus up at night. That audit is now on his record. For the next 6 years, every return he files has an elevated chance of being selected for review. The fix is almost stupidly simple. You need a separate account. If you use AI tools for business, create a dedicated business account with a separate email. Pay for it with your business card or bank account. Never, and I mean never, use it to ask what movie you should watch tonight. The IRS can't argue with clean separation. One account for money-making activities. One account for everything else. $20 a month times 2 subscriptions is cheaper than 1 audit. The second deduction causing chaos is the AI automation software stack. I'm talking about Zapier, Make, Den, Bardeen, any tool that connects apps and automates workflows. A freelance social media manager named Priya, 27 years old, based in Austin, had built an incredible automation system. She used Make to automatically pull content from client Google Sheets, format it, schedule it to buffer, and log everything in Notion. Genuinely impressive setup. She spent $1,180 on automation software in 2024 and wrote off every dollar. The IRS flagged her return in March 2025. Here's why. Her gross business income was $31,000. Her automation software expense represented 3.8% of her total revenue. That ratio triggered an automatic review because the IRS has identified that anything above 2% in this category warrants a second look. But Priya made a second mistake that turned a flag into a full audit. When she claimed the deduction, she categorized it as computer and internet expenses. The IRS agent noted that her internet bill was already claimed separately, so now it looked like she was double-dipping. The audit took 4 months. She had to produce every invoice, explain every automation, and demonstrate that each workflow directly generated revenue. She eventually won. The deduction was legitimate. But she spent 40 hours dealing with paperwork and $800 on a CPA to help her respond. Here's what would have saved her: proper categorization and documentation. Automation software should be listed under software subscriptions, or SaaS expenses, not lumped into computer and internet. And you need a one-page document that explains, in plain English, what each tool does for your business. You don't need to submit this with your taxes. You need to have it ready if anyone asks. Keep that ratio in mind too. If your AI and automation expenses exceed 2% of your gross revenue, you're not doing anything wrong, but you should expect questions. Have answers ready. The third flagged deduction is the one that genuinely surprised me. It's AI-generated content for resale. And this is where things get legally complicated. There's a creator, I'll call him Derek, who built a side business selling AI-generated children's coloring books on Amazon KDP. He used Midjourney to create the illustrations, ChatGPT to write the page prompts, and Canva Pro to format everything. His total AI tool costs in 2024 $576. He sold 8,400 worth of coloring books. Solid profit margin. He wrote off his AI subscriptions as cost of goods sold. This is where he went wrong. Cost of goods sold has a specific legal definition. It's the direct cost of producing inventory. For physical products, that's materials and labor. For digital products, the IRS argues it's the cost of the specific assets you're selling, not the tools you used to create them. The distinction matters because COGS reduces your gross income before other deductions are applied. It's more valuable than a standard business expense deduction. Derek was essentially claiming his AI tools were worth more than they were in the tax code's eyes. His deduction was reclassified. He owed an additional $89 in taxes. But here's the part that should scare you. The IRS agent noted in his file that his business model was AI content arbitrage and flagged him for potential review if his income from that source exceeds $20,000 in future years. If you sell AI-generated content, write off your tools as software subscriptions, not cost of goods sold. It's less advantageous, but dramatically safer. Now, if stories like this fascinate you, if you want to actually understand how money works instead of just guessing, subscribe. I upload one video every single day, breaking down exactly this kind of thing. While we're here, I should mention that if you're creating content using AI voices for anything business-related, the tool I've seen stand up best to scrutiny is 11 Labs. I've linked it in the description. Try.11labs.io 2PU109Y92J1 because their business accounts actually generate proper invoices that accountants love. Clean paper trail. That matters more than you think. The fourth deduction being flagged is AI education and course expenses. And this one makes me angry because it's hurting people who are genuinely trying to improve their skills. A woman named Jasmine, 23, works as a junior marketing coordinator. She wants to transition into AI-focused roles. In 2024, she spent $1,200 on courses teaching prompt engineering, AI workflow design, and automation strategy. She claimed these as professional development expenses. The IRS denied the deduction entirely. Their reasoning? The courses were preparing her for a new career, not improving skills in her current job. This is an old rule. It's been on the books since 1967, but it's being applied to AI education aggressively now because the IRS sees these courses as career changes, not career enhancement. Here's the specific test. If the education qualifies you for a new trade or business, it's not deductible. If it improves skills you already use, it is. Jasmine's fix would have been framing and documentation. If she had taken courses specifically on AI for marketing professionals instead of general prompt engineering, the deduction likely would have survived. If she had documented how she used AI tools in her current job before taking the courses, she'd have evidence that she was enhancing existing skills. The action step here is precise. Before you buy any AI course, write one paragraph explaining how it improves your current job. Save it with the receipt. That paragraph might save you hundreds of dollars if you're ever questioned. The fifth deduction, and this is the one I mentioned earlier that's actually legal but getting flagged anyway, is the home office deduction for AI-related businesses. The IRS has always scrutinized home office claims. But in 2025, they're specifically targeting people who claim home offices for businesses that are primarily digital and AI-driven. Their internal guidance suggests these businesses don't require dedicated physical space because the work can be done from anywhere. This is wrong. And I mean factually, legally wrong. A tax attorney I spoke with, she's represented 11 clients fighting this exact battle in 2025, told me the IRS is losing these cases, but they're still flagging them because the agents on the front lines don't understand how AI businesses actually work. If you run any kind of AI-assisted business from home, you need to document your space requirements. Do you need multiple monitors to compare outputs? Document that. Do you need a quiet space for recording AI-generated voiceovers? Document that.